Welcome back, and joining us on the show now is Zhuwei Wang. He is Manager, Asia Oil Analytics at S&P Global Commodities Insights. Mr. Wang, hi, thank you so much for joining us. First of all, the crude oil prices seem to be taking in a lot of support from geopolitical tensions and then potential disruptions which are impacting crude, whether it has to do about inventories or supplies or even the Atlantic hurricane season, which is just about 2 weeks later now.
Thank you, Manisha, for having me. Regarding the geopolitical tensions, indeed, it's causing a lot of the volatility of the oil prices in the past few weeks. But for now, we do not remains uncertain regarding the potential disruptions of the supply because the geopolitical tensions. But indeed, there are a lot of wild cards now in the market. Starting actually from the 1st of May, we already see the Israel and Iran tensions, not to mention the Red Sea tensions, started to already play a role in terms of the price volatility starting from the beginning of this year. But overall, we think that we need to watch out for the geopolitical tensions in the upcoming weeks. Remains very uncertain, but we need to watch out for the potential escalations of those conflicts.
What also are you looking forward to in sense of the OPEC meeting in the first week of June, and also the output cuts, the world demand, the kind of reports that we've seen come in this week itself from OPEC and the IEA?
For the OPEC Plus, indeed, right? So our S&P Global Commodity Insights view is regarding the upcoming June the 1st meetings will be very important and will determine the production quotas as well as the voluntary cut. For now, we think that OPEC Plus will continue to embrace the restraint principles, and that means the outcome of June 1st meetings will highly likely to be extending the quota as well as to extend the voluntary cut. So that is our house view for now.
All right. Well, that's something that the market seems to be anticipating as well overall. But what's your sense on the crude oil prices now for this quarter and demand and the summer driving season? Do you see that in sense also supporting prices going forward?
For the prices, I think we talk about prices, right? So it's not only about the quota, but it's also regarding with the supply and demand balances. I think starting from the demand side right now, we actually are standing at the beginning of the summer drive seasons. And that means from the seasonal patterns, we will see some ride of the demand drive ups from now until the end of third quarters, which will be kind of bullish for the oil prices. And on the supply side, right, we will also see some emerging trend. Actually, we already see an emerging trend starting from last year. That is the non-OPEC plus productions growth is already higher and will likely be higher than that of total demand growth of the oil liquids. So that actually has been, putting down a lot of pressure and also the responsibility of the rebalancing upon the shoulders of the OPEC plus. But at the end of the day, right, when we talk about prices, it's also related with the inventories. So based on our supply-demand balances, now we are forecasting that starting from May throughout the July or the August, the global oil inventories will likely gradually drawing down, and that will be providing some upside pressure and upsides for the oil prices in the upcoming month.
Mr. Wang, I'm still going to push you for that number then. So with all what you said in sense of fundamentals, are we looking at a $90 a barrel coming back in this quarter for the Brent prices?
We are looking at, I should say that our house view is that the oil prices will be going higher than the current level. And it will be range bounding between the 85 to 94 US dollar barrel in the upcoming month.
Another important point when we look at commodities clearly comes in from China. I mean, we've seen a $1 trillion yuan bond issuance there. And then, of course, there is Chinese data, which seems to be uneven at best. But even then, there are more positive cues now coming in. What's your sense on Chinese demand and the crude price impact?
I think there's a lot of mixed messages and pictures about China's oil demand. On this positive note, for now, we actually are seeing more determined stimulus packages announced by the central government, and actually will be translating into more push into the infrastructure, and therefore will be translating into more the demand in the transportation sector as well as the industrial sectors. However, at the same time, right, we're seeing that for example, the real estate sector are still struggling with the high debt levels. And this not to mention that we're also seeing some potential structural changes in China's oil demand. That is the energy transition impact to the oil demand in the transportation sectors. One of the very most important examples, I think, is about electric vehicle penetrations in China, which is very severe now. I think will be posing more downward pressure upon the gasoline demand in China in the upcoming years.
Well, that could be the cue coming in from China. But when you look at towards India, what is the kind of demand growth that you're seeing there? I get your point when you say that there are elections in many countries this year, and that is something that would keep the crude oil prices perhaps slightly under pressure. But when it comes to the GDP numbers, when it comes to demand for this year and the next as well, what is your house view?
For the overall India demand as well as for the economy shape, we still think India's economy will be still remain very healthy. We are forecasting the total GDP growth for India during the fiscal year of 24-25 will be still around 5.1%, and it will be still at around 5% next year. And in terms of oil demand growth, we are also seeing similar trend. That is, the total oil demand growth in India will still be very resilient this year as well for next year. So in terms of percentage-wise, we think that oil demand will still be growing at more than 4% this year as well as for next year.
Okay, all right, Manisha, thanks very much for taking us through that conversation. Well, that's on the entire commodity space. Well, we need to, in fact,